Financial fair play is supposed to protect football clubs from bad owners, but in my estimation, it is failing. The rules were brought in a decade ago, but it's only in the last couple of years that the debate has become a lot more heated, with Everton and Notts Forest getting points deductions in the Premier League last year, and Manchester City facing 115 charges that are still to be resolved. It's these recent issues that prompted me to actually look at the rules and the controversies in a bit more detail. Now, Everton Football Club look like they're bringing an end to their ongoing saga of trying to sell the club, subject to regulatory approval. But Everton are currently still arguing with the Premier League about accounting issues, whilst being hundreds of millions in debt. So I'm going to take you through the situation that Everton Football Club finds itself in and explain the insane spending habits, 500 million of losses in 7 years, the ongoing dispute with the Premier League about interest costs, why they've found it hard to sell the club, and how the club has 400 million more debt than you might think. This is your full context look at Everton, their finances, and FFP. For those of you who don't know me, I'm Tim. I'm a qualified chartered accountant and for more than a decade held senior finance positions at big and small companies after training at some of the largest accounting firms in the world. I'm also a huge football fan. Before we get into it, let me give you a quick background. Financial fair play is the old name for the current spending rules around football in England, now called Profit and Sustainability Rules or PSR. These mean the same thing, and I'll be using them interchangeably as we go. So PSR was brought in to try and protect football clubs from bad owners who would overspend, get the club into debt whilst trying to climb the football ladder or win trophies. Now, between 2000 and 2013, I found at least 44 English clubs that went into administration. And if you went further down the league pyramid, I'm sure you would find even more. Many of these clubs played in the Premier League or in the professional pyramid. But since 2013, there have been just 5 teams that have entered administration. So on face value, the rules seem to be doing a reasonable job. Now, the rules do vary between the different divisions, but all have the aim to stop clubs from overspending or spending money they don't have or can't afford to lose. In the Premier League, this means that you can't make a loss of more than 5 million per year or 15 million over a 3-year period. You can, however, make a greater loss of 35 million per year or 105 million over 3 years if the club provides evidence of what it calls secured funding. This is effectively the owner putting funds into the club. These losses do exclude investments for the long-term benefit of the club, like stadium, infrastructure, academy, that kind of thing. Now, opponents of FFP will argue that this stops smaller clubs from spending money to achieve what the bigger clubs can, because owners can't spend as much money as they want, like when Chelsea and Manchester City were taken over many years ago. It also seems harsh that the punishment for breaking the rules, as we've seen last season, is a points deduction which principally punishes the fans. It does look like the Premier League will be moving to a different set of rules involving maximum spending, but for now we are still under the PSR rules as they stand. Now, Everton are a football club that enjoyed a lot of success in the 80s, winning multiple leagues, cups and European competitions. They enjoyed a period of great stability through the noughties and through to 2020 before stumbling into mid-table and narrowly avoiding relegation over the last few years. Farhad Mashiri purchased the club in 2016, and we're going to look at just how much the club has changed since then. So finally, let's get into it. So in 2016, Everton had accumulated losses of £68 million and total borrowings of £57 million, having just taken out a new loan for £35 million. So the overall balance sheet had net liabilities of 43 million. Now, that's probably a little higher than I would like if I were in charge, but it's not totally crazy given that the club has income every year at that time of 121 million pounds. Its annual interest cost was just 5 million. Now, for a football fan, you might want to think of this as one player earning around 80,000 pounds per week that they don't have because they've got to pay interest on their debt. So they also paid 133 million for their current squad. Compare that to 2023, just 7 years later. The club has accumulated losses of 550 million, borrowings of 341 million, but the overall net assets of the club did go up to 221 million, and they had paid 374 million for their current squad. They also spend 159 million on wages. Now, this is mostly the first team squad, but does include other club staff, and that is 92% of their total revenue. In 2016, the total staff costs were 83 million, just 68% of their revenue at the time. Now, the final metric for you is squad cost amortization. So to briefly explain how football clubs account for their transfer fees, it looks like this. You sign a player for £15 million on a 3-year contract. And instead of saying that the cost is £15 million in that first year, you actually take that cost and it is spread over the period of the player's contract. So for a 3-year contract, that would be £5 million per year. You can think of squad cost amortization as being like a proxy for how much they have spent over recent years and how much you would need to keep spending in transfer fees to renew the value of the squad. In 2023, this was 77 million compared to just 22 million in 2016. Let's talk about debt first. You may have noticed it looks odd that Everton have made such great losses and have so much more debt, but somehow their net assets have increased. Well, good spot. But there are a couple of reasons for this. Firstly, Mashiri has given additional money to the club of £300 million. This is called the share premium in the accounts. This is effectively him gifting money to the club. Most likely, this is due to the necessity to do so because of their losses under FFP. But there is something else, something that's gone a little bit under the radar, and that is the other reserve that you can see here of 447 million. The accounts do a great job of disguising what this is from anyone but an eagle-eyed accountant like me. But this is actually a loan from Blue Sky Capital, which is a company controlled by Mashiri. Now, this isn't classified as a loan because there is no contractual repayment and it attracts no interest. So this is the correct accounting treatment. There is nothing wrong with this other than it not being immediately apparent to non-accountants how much debt the club actually has. So if you think about this other reserve as the loan that it really is, you can see that the borrowings would have increased by a massive 700 million, and the net liability position of the club has worsened by almost 200 million. Now this really does give you a flavour for how bad the state of the club's finances really are. Every single financial metric has worsened since Mashiri purchased the club in 2016. Now, Everton are building a new stadium and have spent 386 million on the stadium so far, including debt interest, which we'll come on to in a minute. This will also be contributing to the increased indebtedness of the club. I know that's a lot of big numbers, but what does this all mean and does it matter? As an Everton fan, should you be happy that the owner has given so much money to the club to pay for a combination of a new stadium and better players? Obviously, you can argue that some of that money was poorly spent, but in principle, how do you feel about the financial position of the club? Having spent almost 400 million on a stadium and expected to cost 500 million, but reports now indicate that this could cost as much as 750 million. The club may have to find another 400 million just to complete the building of the stadium. Now, I'm going to come back and answer this at the end of the video, but for now, just think about the amount of debt the club has of close to 800 million and needing to find maybe another 400 million to complete the stadium, and their revenue was only 172 million, whilst making a loss of 89 million last year alone. If a business had numbers like this, and it was anything other than a football club, it's not a business. And the club even acknowledged their difficulties in continuing to operate in their current financial position. In their accounts, they have a large section talking about their ability to stay in business. This is called the going concern in accounting language. And they say that they anticipate running out of cash in Q3 of 2024, which we're just coming into. Their loan facilities include covenants, meaning that they would need to be repaid if they were relegated. Neither Mashiri nor the prospective buyers at the time, 777, could formally confirm their intention to provide financial support to the club. Funding the remainder of the stadium had not yet been secured, and they acknowledge that these conditions may cast significant doubt on the club's ability to continue as a going concern, or, in other words, may cast significant doubts on the club's ability to continue trading. As a corporate auditor for many years, let me tell you that it is very rare in the business world would you go into this level of detail about your ability to keep trading. The auditor also acknowledges the material uncertainty, drawing attention to it specifically in the auditor's report, something which auditors would never do unless they believed it was a material uncertainty. Material in accounting language, meaning that it is big enough that you need to pay attention to it. And whilst you're mulling that over, I want to talk about the recent PSR changes and points deductions. Specifically, I want to talk about the fact that the club and the Premier League are still arguing over the accounting treatment of interest costs for the stadium. If you don't know, Everton were charged with breaching PSR by 23 million last season, but only admitted to a breach of 17 million due to the interest cost of 6 million relating to their stadium costs. As we mentioned before, costs relating to investment in things like stadiums are excluded from PSR. So the thing to understand here is that we have to see the woods from the trees, and we need to keep the big picture aligned. This is an argument over £6 million, when the rules were breached regardless, and the club will probably have more than 1 billion of debt in a couple of years' time. The club also made a loss of 89 million last year. Now, of course, this interest cost will continue to increase in future years, meaning it will become a bigger portion of the club's PSR calculation while the stadium is being built. So I can see why this is being pushed by the club. However, still relatively small numbers compared to Everton's overall indebtedness and overall losses. And I find it very hard to find any good articles or information or insights actually talking about this dispute on interest. Most were giving a pretty poor explanation of what's happening, and in all honesty, it's not too surprising given that most sports journalists are not qualified accountants. Now, as an example, this is an article from The Athletic, which is a dedicated sports journalist site owned by the New York Times. Author Patrick Boylan has done his best, and he's gone into detail speaking to a guy called Kieran Maguire, who is a football finance expert at the University of Liverpool. But unfortunately, this article misses quite a lot and gets other things wrong. So, firstly, he talks about how the auditors are entitled to qualify the accounts if incorrect, and that it's fairly standard practice to capitalize interest cost on construction. And this is true, but it misses a lot of context, which is why we're here. So, Everton's accounting policy was not to capitalize the interest. They then changed their accounting policy to capitalize the interest and subsequently restated their accounts for the previous year. This in itself is unusual but allowable and should warrant a closer look. Either treatment is actually fine, capitalize your interest or don't, so long as you are consistent. As an outsider, it is kind of crazy that they didn't adopt this policy of capitalizing the interest in the first place when the construction started. The CFO, directors, advisors, auditors should all have seen the benefit for PSR purposes, which makes me think maybe there was a reason they didn't. Now, earlier in this article, they start quoting international accounting standards and particular sections relating to borrowing costs and accounting policies, whilst joking about their dryness and obscurity, which I can't disagree with. They completely omit the fact that they're irrelevant since Everton does not report under international accounting standards. The quote small football finance expert later in the article even say that they report under Financial Reporting Standard 102, which is effectively the UK accounting standards. So why then do the Premier League want to argue this point when the club and its auditors seem quite happy with the treatment? Well, let's look at last year. They capitalised £210 million relating to the stadium, of which 19 million was interest. So around 190 million of construction costs. Now, we don't actually know how much interest Everton's loans attract, except for those given by Mashiri, which are mostly interest free. But we can speculate based on our knowledge of typical lending rates and the interest costs that are disclosed. Now, most likely, the 190 million would have been spread over the course of the year, making quarterly or monthly payments to their main contractor. Under this assumption, they're paying around 7% interest, which is perfectly normal borrowing rate, but perhaps a little low considering that the funding was not secured to complete the construction of the stadium. Borrow to build rates would probably be a little higher. Everton are not exactly able to guarantee the loans, and the stadium can't exactly be sold to anyone else if the club were to default on its loans. The problem the club has, and I think why the Premier League might be arguing this, is not all of their borrowing is normal. We know that they have around 450 million in interest-free loans from Mashiri. So there is a debate to be had as to how the interest was calculated relating to the stadium. Was the stadium paid for by Mashiri's loans, the external loans, or a combination of both? Worth pointing out here that if Everton's interest-bearing loans come to 340 million and their interest cost for the year is 19 million capitalized plus 3.5 million in their profit and loss, for a total of 22.5 million in interest payments, depending on when they drew down on the loan facilities in the year. This puts their interest on external loans between 6 and 12%, probably somewhere in the middle. The point I'm getting to here is that when you have a big borrowing pot, the relevant accounting standards state that you should average your borrowing rate, or use the weighted average rate applicable to the general borrowings. So if the club are borrowing externally at say 9% and have an equal amount of interest-free borrowings, their average rate would be 4.5%. Now, what we don't know here is if any of the loans were specifically for the stadium funding. What the borrowings are and what the capitalisation rate is. To be honest, these are all things that the club's accounts are legally required to show under FRS 102. Section 25.3a and 11.42. I think this is definitely a big miss from the club and its auditors. These numbers should be disclosed and would help the users of the accounts understand more about this disagreement, particularly given how significant they are. Hopefully, Everton will rectify this in their 2024 accounts, and we will know a little bit more. Personally, I think the interest rate used to capitalise the interest is the dispute here. And given almost all of their interest costs were capitalised, that is 19 million versus the 3.5 million, it seems Everton are arguing that most of their external borrowings are entirely stadium related. The Premier League, I think, do have reasonable cause to further interrogate this and confirm. This is obviously something we could only know if we had the documents, but hopefully this is resolved by the Premier League and the club, and we get told the reason for this dispute and the decision. Let's lean back again. I asked you before, would you be happy if this were your club? What if you had seen some reasonable success? Would that change your mind? If Everton finished fourth last season, would you be okay with the state of the club's finances? I haven't wanted to talk too much about 777 Partners, but they loaned Everton approximately 200 million and recently failed in a takeover of the club in the midst of allegations of fraud. As of August 22, Mashiri was still trying and having some difficulty in selling the club due to some combination of reputational and legal risks around 777 and financial concerns generally, although it now looks like a sale to Dan Friedkin and the Friedkin Group will go ahead. Let me present you with a scenario. It seems to me that the cash required to sustain the club is now beyond the means or the appetite of Mashiri. Cash requirements which Mashiri himself have placed on the club. A club making an operating loss of 130 million in 2023 and 100 million in 2022. A club that needs to find many hundreds of millions, most likely in the form of debt, to complete the construction of their new stadium. A club that already has around 800 million in debt. What if he were to have problems selling the club? What if he cannot or does not want to continue to bankroll the losses and cash outflows that he himself has instigated? Whilst Everton as a club and a brand has a lot of value, I would argue that it's probably not valuable enough to compensate for the financial position that the club is in. At the moment, we don't know the price and the nature of the proposed sale to the Friedkin Group, but more than likely, very little is actually being paid for the club in exchange for the prospective new owners just taking on the debt that the club has. Financial fair play and PSR are supposed to protect clubs from bad owners. Even those with the best of intentions get things wrong. But those rules have allowed for a situation where the level of indebtedness and overheads is not just unsustainable by anyone who doesn't want to be consistently dumping hundreds of millions into the club, but it's also not easily reversible. In a worst case scenario of the club entering administration, there may be insufficient cash reserves to continue to pay their playing staff. That could mean player fire sales or even contract terminations by the administrators. This is admittedly an unlikely scenario, but not an unreasonable one. Something that I think the club and their auditor would agree with, given their statements on going concern that we talked about before and potentially running out of cash in Q4 of 2024. I think both the fans and the Premier League should not be willing to accept such a risk when owners are looking to stretch the means of a club. And I want to be very clear. As an investor myself, I am all for using debt in the right ways. Use it sustainably and when the business case makes sense. But the future sustainability plans of any business following a period of overspending cannot just be some possible future revenues from success, because that may take a long time to come and may never come at all. I'm also all for owners putting as much money into the club as they want, but they should have to gift the money to the club to cover the future liabilities that that club may not be able to afford. This should include all 5 years of the superstar striker's wages when the club cannot afford them. And you absolutely should not commit the club to hundreds of millions of spending on a new stadium before you know how you're going to pay for it. At the start of this video, I said that FFP appears to have done its job, and we've seen far fewer football administrations. But perhaps we've actually just created a back-ended risk and a ticking time bomb for multiple clubs. Perhaps we would have seen more administrations if the value of clubs skyrocketing over the last 10 years hadn't bailed out some of these owners. And whilst I've talked about Everton in this video, I could easily have picked many others. Derby County, who were in administration not long ago, Notts Forest, Aston Villa, and Barcelona could all have been good cases to explain the same point. And perhaps Aston Villa fans feel happy with their ownership given their recent success. but they too would be in the same boat should their owners not wish to support the club going forwards. 200 million of loans repayable on demand from the owners and 116 million of losses from just 204 million in revenue. With redevelopment of Villa Park on the horizon, I would fully expect the level of borrowings to grow and the losses to continue. Not to mention that Villa Park was already sold to their owners a few years ago in order to comply with FFP at the time. Derby County did the same thing just prior to going into administration. The bigger problem, of course, is that the Premier League and Football League rules changes are voted on by the clubs and need heavy majorities to pass, meaning it is unlikely that requirements on owners to put more money into clubs would be passed. Of course, I hope for all our clubs at home and abroad that no one sees the team they love suffer because of irresponsible ownership. But the league and fans should be aware of the long tail of risk that their club is given when they are spending beyond their means, not just on expensive players, but also on infrastructure and things outside of the scope of the profit and sustainability rules. This might not happen today, this season, or next, but if your club is overspending unsustainably and the owners decide not to supply cash to cover future liabilities as well as the present ones, your risk of ruin increases every season. This has been your full context view on Everton and financial fair play. If you like this, give me a like and a subscribe. Let me know in the comments what you think about your club's ownership and if you'd like me to give the full context on your club. Thanks for watching.